Welcome back to Strictly Money. So, if you've gone to a bank or spoken to a financial advisor about investing in a mutual fund, there's a good chance that you've been offered an option to buy a segregated fund. That is a fund that offers a guarantee when the fund matures or when you pass away. Now, depending on your situation, a seg fund may or may not make sense. And to help us decipher all the considerations is Jason Heath. He's a fee-only financial planner with Objective Financial Partners, and he joins me now. Jason, great to have you on.
Yes, thanks for having me again, Saijal.
So I am really glad to have you explain seg funds because I know so many people who've been offered this. I've been offered it. My parents have been offered it. And on the surface, it seems great because, you know, who doesn't like a guarantee? but I know it's not that straightforward. So maybe explain first what a seg fund is.
So a seg fund, a segregated fund, it's kind of like a mutual fund in that it's a large pool of money that's invested by a bunch of different investors in a bunch of different investments, whether it's stocks, bonds, combination. There are segregated funds that are 100% in stocks. There are segregated funds that are 100% in bonds. There's segregated funds that are a combination of the two. And when an investor invests in a seg fund, whether it's $50, $50,000, $500,000, you own a small proportion of the big pool of assets that's managed by the fund company. I think one difference compared to a standard mutual fund that people are used to is that a segregated fund is structured as an insurance contract. It's issued by an insurance company. So as a result, there are certain guarantees, as you mentioned, benefits, protections, things like that, compared to an investor that owns a mutual fund. And those guarantees typically come into play when, as you mentioned, the fund matures or after a certain period of time or when the investor dies.
Okay, so let's talk about the guarantees because my understanding it is also varies, right? It depends on the type you're buying. Like some are 100% guaranteed, but not necessarily.
Right. Yeah, some contracts will guarantee 75%, some will be 100%. The guarantee is based on your initial contributions minus any withdrawals you've taken. So it's a principal guarantee, which sounds good. I always tell people when it comes to financial products, when you hear guarantee, that usually means expensive. And I think that's really important. The guarantee typically applies after 10 years or upon death. And over a 10-year period, it's very unlikely for a diversified portfolio of investments to have a negative rate of return. So even a 100% guarantee, let alone a 75% guarantee, may not be that valuable after all.
Yeah, so let's talk about that because in your experience, does that guarantee really even make sense? I always say, well, like, why wouldn't you just buy a low risk, diversified, blue chip fund that over 10 years will likely go up? And if you really want that guarantee, you buy maybe a GIC. Wouldn't that make more sense?
I think so. I think a diversified portfolio is probably going to give you a better outcome. I can't say for certain, but I suspect that in nearly all 10-year periods that you could pick, you'd come out better off in a diversified portfolio of investments, in large part because of the fees that are involved with seg funds.
Yeah. So what are the fees? Usually a typical mutual fund is about 2% MER.
Yep.
Compared to that, what does a seg fund charge?
So seg fund fees tend to be about 1% higher than a typical mutual fund. As you mentioned, in Canada, the average fund fee is about 2% for a mutual fund. So seg funds are typically in the 3% range, which is pretty expensive regardless of how you invest your money. But I think often the people who gravitate toward guarantees are more conservative investors. And I think that's what can make seg funds even less appropriate or more challenging, because if you're paying 3% in fees and you're in a conservative portfolio where the bond portion's earning 3%, you're paying 3%. I mean, 3 minus 3 is 0. So you might have a good portion of your money that's just going sideways.
Yeah. We have about 45 seconds until the break. You mentioned there's a period that you would be locked in for. Does that vary? And if you do sell beforehand, is there a penalty?
Well, sometimes mutual funds or segregated funds can have deferred sales charges where there is a penalty to get out. You may be foregoing the guarantee, but again, the guarantee may not matter. Your principal, particularly, given how markets have performed in recent years, will probably be, well protected and then some. There are some other benefits to segregated funds related to creditor protection for business owners, related to estate planning benefits because they can avoid probate and estate administration
So
tax.
hold your thought on
There
that,
are other
Jason.
reasons why.
Welcome back. Jason, before the break, you were talking about when segregated funds do make sense and estate planning. You can use it there, and as well as creditor protection. Let's go through that. Talk about the estate planning piece.
So on the estate planning side, if you own segregated funds, because it is an insurance contract, you can have a named beneficiary that upon your death, the account pays out to directly. Some registered accounts like RSPs and TFSAs can also have named beneficiaries where assets pass directly to them. But in a non-registered, like a taxable investment account where you can't normally have a beneficiary, if you own a segregated fund, it can bypass probate, it can bypass here in Ontario estate administration tax. Providing a death certificate can be enough to have the funds paid out as opposed to going through the process of probating a will, legal fees, costs, time involved, and other complexities.
Okay, so presumably then you have to actually hold the fund, and when you do pass, so the underlying assets, something conservative would then make sense, wouldn't it?
Yeah, it can, have an estate planning benefit. I think the real challenge is even here in Ontario where, probate or estate administration tax is 1.5%. If you're paying an extra 1% per year for 10 or 20 years, is that worth it to then save 1.5% on the back end? So pros and cons to the estate planning benefits for sure.
Okay, and creditor protection?
Yeah, so there is creditor protection because it is an insurance product. It's not considered a regular type of asset. So business owners are often encouraged to consider segregated funds. So a segregated fund that you own in a non-registered account or in a corporate account, for example, may have creditor protection. Often our RSPs, depending on the province or territory in which you live, have creditor protection already. So there is some limited benefit for sure for business owners or other people who might be exposed to creditor risk.
Okay. I want to switch gears, Jason, and talk about universal life as an investment strategy, because it's kind of different, right? It's, again, insurance product, but then you have this investment piece. So it's sort of, I don't know if you call it reverse. But when does it make sense to buy a universal life policy? Because I get asked that question a lot.
Yeah, so I think most people are familiar with sort of typical term life insurance where you buy a policy for a 5-year or a 10-year term, you pay a premium. If you die during that period, it pays out. Or you've got group insurance at work, which is group term insurance. Universal life insurance is a type of permanent life insurance that combines insurance with an investment component. So you can contribute more to the policy than just the pure cost of the life insurance premiums and use those contributions to buy mutual funds effectively that can grow on a tax deferred basis subject to certain conditions related to the policy itself.
So who does it make sense for? I mean, I have to think, well, you just mentioned tax deferred. So I assume when you use up, say, your RSP contribution room and your TFSA contribution room, it would make sense for someone who's in a more higher tax bracket?
I think so. I think that if you haven't already maxed out your RSPs and your TFSAs, universal life insurance, may not be appropriate. The benefits are that much more so for someone who's building taxable non-registered investments, who's, as you mentioned, in a high tax bracket. Candidly, most of the universal life insurance policies I see are not that profile, interestingly. So I think it's really important to understand what the benefits are and take advantage of other RSP and TFSA contributions that may be simpler and more beneficial in the long run from a tax perspective.
Okay, we have about 30 seconds left. What does someone have to consider though when they buy it? What should they be aware of? I guess fees. There must be some sort of stipulations.
Sure. I mean, one of the big challenges with Universal Life, the investment component tends to have higher fees than alternative investment options. So you may be saving tax, but you're paying higher fees. Is it worth it? I think the other challenge is the insurance premiums tend to be quite high. And particularly if somebody hasn't already done a good job of covering themselves off in other areas like, disability insurance, which can be really important, but can have really high fees. You shouldn't be jumping into an expensive life insurance policy that's fancy when you haven't dealt with other parts of your risk management for insurance.
All right. Jason, thanks so much for coming on today. Really appreciate it.
Thanks for having me, Saijal.
Jason Heath of Objective Financial Partners. Well, that wraps up this edition of Strictly Money. If you have thoughts or questions about the show, drop us an email. We'd love to hear from you. Until then, stay well, stay wise, and stay wealthy. We'll see you next time.